Adding extra to super can cost less than it looks. 15% in the fund versus 30 cents on your wage. We did that maths in part 2. This is how you actually put more in, and when you can take it out. This is part 4 of the Australian Super Series, Salary Sacrifice versus a Personal Deduction, Catch Up, Spouse, the First Home Super Saver, and Preservation Age. General information only, not personal financial advice. Check ato.gov.au or moneysmart.gov.au for your situation. Before you add $1, know this year's concessional cap. It is $32,500 from the 1st of July 2026. Employer 12% counts first. On that $80,000 plus super example from part 2, the boss already used $9,600. Room left, $22,900. A $5,000 salary sacrifice on that wage uses $14,600 of the cap. The fund takes $750 of the extra $5,000. 2 jobs. Add both. Check my governor, do not guess. 2 common ways to add before tax money. Salary sacrifice. You ask your employer to send part of your pre-tax wage to super instead of your bank. They do not have to say yes. If they do, that extra is concessional. The fund takes 15%. It does not replace the 12%. The employer still calculates super guarantee, as if you had been paid the sacrificed amount, for ordinary hours. You cannot sacrifice your way out of the 12%. Personal deductible contribution. You pay from after-tax money yourself, then claim a deduction so it becomes concessional. Same 15% in the fund. Same cap. You must give the fund a valid notice of intent, the ATO form, or the funds form, and get an acknowledgement before you lodge your tax return, or by the end of the next financial year, whichever is earlier. Miss the notice, and you may not get the deduction. Which one? Salary sacrifice needs payroll. A deduction works if you are self-employed, between jobs, or your boss will not package it. The tax outcome can be similar. The paperwork is not. Age 67 to 74, you generally need the work test to claim a personal deduction, 40 hours work in a 30-day stretch that year, or a 1-year exemption if you qualify. Salary sacrifice does not use that work test. From 75, the window is tight. Only contributions before the 28th day of the month after you turn 75. Check ato.gov.au if that is you. Catch up. If you did not use the full concessional cap in earlier years, you may bring unused amounts forward. 2 gates. Your total super was under $500,000 on the 30th of June last year. And you have unused cap from up to the previous 5 years. Unused bits expire after 5 years. For 2026-27, that is unused from 2021-22 through 2025-26. The ATO applies the oldest first once you go over this year's $32,500. Look it up in My Governor, do not invent the number. Spouse. 2 flavors. You can split some of your concessional contributions to your spouse, ask your fund. Or you can contribute to their super and claim a tax offset. Offset is 18% of up to $3,000, maximum $540, if their income is $37,000 or less. It phases out by $40,000. They must be under 75, under their after-tax cap, and under the transfer balance cap. It is a modest offset. It can still be useful if one of you is out of the workforce. Government co-contribution. If you put in after-tax money, and you do not claim a deduction on it, and you meet the ATO's rules, the government may add 50 cents in the dollar, up to $500. For 2026-27 the full 500 is if your income is 49,293 or less, and you put in 1,000 after tax. It tapers out by 64,293. Automatic when you lodge. Tax file number on the fund. First Home Super Saver. This is the legal early access path for a first home, not a loophole. Only extra voluntary contributions count. Employer 12% cannot come out. You can count up to $15,000 of eligible voluntary contributions per year, and $50,000 in total. You need to be 18 or older, and you generally must never have owned a relevant property interest in Australia, including an investment or vacant land. There is a hardship exception. Couples can each use their own cap. When you want the money, ask the ATO for a first home super saver determination before the property settles, before ownership transfers. The release is 100% of eligible after-tax contributions, 85% of eligible before-tax contributions, because 15% tax already came out, plus deemed earnings the ATO calculates. Not your fund's actual return. After you sign a contract you generally have 90 days to tell the ATO. If you release the money and do not buy, you can be taxed. Apply through My Governor. Read the ATO page before you use this. It is fiddly, and it still sits inside the 32,500 concessional cap. Downsizer is separate, 55 or older, sold a home you own 10 years, up to $300,000 per person. Different rules. ATO. When can you access the rest? For anyone born from the 1st of July 1964, preservation age is 60. You can usually take super from 60 if you retire, or if you leave a job. From 65 you can take it even if you are still working. You can start a transition to retirement income stream from 60 while you work. There is a 10% a year cap on that. From a taxed fund, withdrawals from 60 are usually tax-free once you meet a condition of release. Early access otherwise is narrow, serious medical, compassionate grounds, severe financial hardship, incapacity, leaving Australia, as a temporary resident, tiny lost balances. It is illegal to cash super without a condition of release. Anyone offering to unlock it for a fee is a problem. Hang up. You do not have to take it all out at 60. You can leave it invested. You can start an income stream. Pulling it out and parking it in a bank account can mean more tax on the earnings. Get advice if the dollars are large. Recap. Cap this year 32,500, employer 12% first. Sacrifice or a documented deduction. Catch up if your balance was under 500,000. Spouse offset up to 540. Co-contribution up to 500. First home, 15,000 a year, 50,000 total, ATO determination first. Locked until 60 or 65. That is the series. Part 1 was the locked box. Part 2 the tax. Part 3 the fund. If you skipped ahead, start at Part 1. Subscribe. Playlist is in the description.